It is now 5 minutes past the hour. So let's get underway, everyone. Thank you so much for joining me this Saturday for our live training. And don't forget, on Wednesday, we will have our Chew the Fat at the same time on Wednesday morning. So we're just sort of mixing it up for the next 5 or 6 weeks while I'm over here in the US. And I think I might come over here more often. Since I left Australia, markets have just been up, up, and up. So we had an extremely strong day here in the US today on Friday. We had one of the US Fed officials on Thursday afternoon, who is a voting member of the Fed, say that he is going to advocate for a 1/4 point rate increase. That comes on the back of a couple of non-voting members saying earlier, probably 2.5 weeks ago, that they would prefer a 0.5% rate increase. So that got the market sort of nervous. Maybe the Fed might raise rates more than what the market expected. And then we had someone who is a voting member yesterday come out and say, no, we'll probably have a 1/4% rate increase. So the market really liked that. A lot of money came back into the market late in the afternoon on Thursday. That momentum continued in the trading session through Asia on Friday, then through the European trading session, and of course, into the US trading session. So it was a really strong day. The NASDAQ was up 2%. A lot of the big tech companies were, somewhere between 2 and 3% higher. We did see Costco was a little bit lower. I wrote a little piece late this afternoon that'll be in your Monday morning report. I think any pullback on Costco is a buying opportunity. The only reason why it was a little bit lower on Friday was the fact that it issued its latest earnings report. And it's interesting because Costco actually did better in the last quarter than the previous quarter to that, and did actually better in the last 12 months to the previous 12 months. But it didn't do quite as well as what some Wall Street so-called experts expected. So the market sold it off just a little bit. Any discount on businesses like Berkshire Hathaway, Costco, that sort of thing, in my opinion, is a buying opportunity. They are wonderful businesses. So I wrote a little piece today, that you'll get on Monday in your report, sharing with you that financial information regarding Costco. It's selling more goods and services. It's making more money. It's getting better as a business. There's not many times throughout the last few years that you would have been able to get Costco at a 20-25% discount. You're certainly not going to get it at the moment. But, if you're someone who owns a business for a lengthy period of time, like a Costco or like a Berkshire Hathaway, like an Apple or something like that for 5, 10, 15 years, then it's, to be quite frank with you, it's not going to matter what you pay for it today, because those businesses have very high returns on capital and will look after you over the long term, provided the management can continue to do what they're doing right now, and that's run the businesses really profitably. And there's also going to be on Monday in your daily report quite a lengthy piece on why return on invested capital is so important. So make sure that you read Monday's report. So all in all, a really positive week. Going into the weekend, investors are bullish. That's on the back of the fact that the US 10-year Treasury yield, which is real barometer for the market with regarding what it thinks the interest rates are going to be here in the US, that was below 4% on Friday. It was above 4% earlier in the week. If the US dollar continues to pull back a little bit, that'll obviously benefit the Aussie dollar, which is risen through the Friday trading session because of that 10-year Treasury yield. If that continues to pull back early next week, then the momentum is going to continue higher. So, we'll take it while we can. Market's bullish, and we just need to sit tight, make sure we focus on owning great quality businesses, which I know you are doing, and that's really all we need to worry about right now. There's nothing out there at this minute that is really concerning the market. Everything is priced in, as far as I'm concerned, with regarding what the market expects. We're through earnings season now. We'll go through a lull with regarding earnings reports for the next month or so, until we start to see the first quarter of 2023's earnings, and they'll be out, not too far away. All right, so that's where we are from the current market conditions. Nothing really for us to worry about. I don't have any intentions at this minute to continue to buy more shares next week. I bought heap of shares in the last week or two because we sold some companies from our portfolio. Walmart, Coca-Cola, PG&E, and Flight Centre used those shares, used the cash to put to work in Alphabet and Macquarie and Berkshire Hathaway. And we're going to do a company profile today on Berkshire Hathaway, a company that will make up the largest percentage in my portfolio by the middle of the year. And I'll share with you why that is as we go through today's company profile of Berkshire. I haven't done one for a while. It's a business that doesn't change that much over time, but it is important for us to keep up to date with what's happening at our major holdings, and therefore I thought it would be relevant for us to do Berkshire Hathaway today. So what I'm going to do first is I'm going to go through and give you a history of the business. Those of you that are not familiar with Berkshire Hathaway, an in-depth understanding of the history and some thoughts from myself, given the fact that I've studied Berkshire Hathaway and Warren Buffett for more than 15 years now. And I feel like I know the company and I know the founders quite well, although I haven't ever met Warren Buffett. Warren doesn't change his spots very often. In fact, he doesn't change them at all. And he's very simple guy to understand with respect to his investing behavior. And once you understand it, once you follow it, once you clone it, you're going to do extremely well over time. So let's get into it. Let's get talking about the history of Berkshire Hathaway first. I'll take some questions at the end of the company profile and anything that is on your mind this Saturday morning, or if you are somewhere else, it would be good afternoon. Berkshire Hathaway is an American multinational conglomerate holding company headquartered in Omaha, Nebraska in the US. Its main business and source of capital is insurance, from which it invests the float, the retained premiums in a broad portfolio of subsidiaries, equity positions, and other securities. I'd like to expand on that for a little minute, because this is really, this second dot point here is really the secret sauce behind Berkshire Hathaway's success. As you're about to learn, Berkshire Hathaway started out as a very, very different business to what it is today. And the reason why Warren Buffett bought the business is a story in itself that you will learn about today. And as Warren has said a few times, he thinks it's the worst investment that he's ever made in his life, buying Berkshire Hathaway many years ago. But essentially, Berkshire Hathaway's success has been built on the back of two things. One, when Berkshire Hathaway went from being a textile mill, which I'll explain in a moment, Warren started to buy insurance businesses. And essentially, when you pay insurance, you pay your premium for your insurance to the insurance company. We all know that only a very small percentage of those premiums are ever actually called upon and claims actually made. So the insurance company has what's called a float. It has a large amount of cash that is sitting around the business. Now, what Warren Buffett worked out many, many years ago was that this cash that was sitting around this insurance business that he owned, he could use that cash and he could invest in marketable securities, listed businesses on the stock market, and he could also buy businesses. So he could buy businesses outright. So just so as you're aware, the Berkshire Hathaway company is worth just shy of about $1 trillion. So it's worth around a little over $900 billion. But only about 300 billion of that is actually shares that are listed on the New York Stock Exchange or the NASDAQ. So the rest of the business, call it $650 million, is actually businesses that Berkshire Hathaway owns outright. So businesses like See's Candy and lots of other businesses, Nebraska Furniture Mart, Geico Insurance, General RE. These are businesses that Berkshire Hathaway owns outright. It owns a number of manufacturing businesses, retail businesses. It owns Clayton Homes, the largest home builder in the United States. It owns a number of car dealerships. It owns a number of jewelry businesses like Borsheim's Jewelry. It owns Dairy Queen. It owns Fruit of the Loom, an underwear business. It owns lots and lots of different businesses outright. And these businesses deliver Berkshire Hathaway a ton of cash. It owns Burlington Northern Santa Fe Railroad, which is the largest railroad network in the United States. It has a very large gas and energy business called Berkshire Hathaway Energy that it owns outright. So the stock portfolio, it's interesting because Warren Buffett around the world, if you asked people, what is Warren Buffett best known for? People are going to say he's best known for buying and selling shares in the stock market. But Warren Buffett, he's made the vast majority of his fortune and the fortune for Berkshire Hathaway shareholders from actually using the money that has been sitting around the insurance business of Geico and the other insurance businesses that Berkshire owns, and actually going out there and buying businesses that are not listed on the share market. That's where the wealth of Berkshire Hathaway as a conglomerate has actually been built. So basically, when you all boil it down, Berkshire Hathaway really is two businesses. One is the listed stocks that it owns, like Apple, like American Express, Kraft Heinz, Moody's, Occidental, etc., and also the businesses that it owns outright, which is Borsheim's Jewelry and all the ones that I mentioned just a few moments ago, Burlington Northern Santa Fe, etc. So the company has been overseen since 1965 by its chairman and CEO, Warren Buffett, and since 1978 by Vice Chairman Charlie Munger. And both of them are known for their advocacy for value investing principles. Basically, a value investor is someone who buys a great quality dollar-producing asset, a company that employs people, sells goods and services, makes profit, and they own those businesses for very lengthy periods of time. That's basically a value investor, and someone who attempts to buy those businesses at below what they're worth. So Warren Buffett really has built his fortune on buying companies on the stock market and buying private businesses for what he believes to be less than what they're worth. And then once he owns them, sitting on those businesses for very lengthy periods of time, so they mature into what the valuation is and much, much more. For example, See's Candies is a candy business here in California. It only makes money for about 1 month of the year. So it only makes money Valentine's Day, Easter, and Christmas time. The rest of the year, it really doesn't make money. And it's a business that Warren Buffett, they paid about $21 million for back in the 70s. But it's a business today that spins off more cash than you can poke a stick at. And a business that, because of the cash that it spins off, Berkshire is able to use that cash to buy other businesses. And they do this consistently. And this is the reason why that Berkshire Hathaway today is sitting on right now $130 billion of cash. It is literally, and it is it's true to say this, Berkshire Hathaway generates so much cash that it just simply can't spend it. It cannot spend the money that it generates. And this is causing a challenge for Buffett because he's never paid a dividend at Berkshire Hathaway. He's chosen to use the cash to grow the business. So this is something that may be a challenge going forward into the future at some point. Under their direction, Buffett and Munger, the company's book value has grown at an average rate of 20% compared to about 10% from the S&P 500 index, with dividends included over the same period, while employing large amounts of capital and very, very minimal debt. So one of the great things about Warren Buffett and Berkshire Hathaway over many, many years, and we saw this, there's no better examples of this, as during the global financial crisis, when Goldman Sachs and a lot of other banks were essentially going bankrupt. And through this period also, some other businesses came to Berkshire Hathaway. They weren't able to raise capital anywhere else. They weren't able to get cash anywhere else. They came to Buffett and said, listen, we need cash desperately. And when you've got the money and you're the lender of last resort, basically you can ask for whatever you like with respect to the return on the money regarding the interest that you're going to earn. And Buffett's done that incredibly well over the years. And one of the reasons why he does like to keep a lot of cash around is because he knows there's always trouble around the corner. He knows there are certain businesses, really good quality businesses, that will run into trouble from time to time, and they'll come cap in hand, as Occidental did a few years ago when they wanted to buy Anadarko. They didn't want to deal with the banks. They preferred to deal with Buffett. The same with Seritage Growth Properties. When they wanted to grow their business, didn't want to deal with banks, wanted to deal with Buffett. They felt like they would get a better deal, a more fair deal through Berkshire Hathaway. And he's made a huge amount of money over the years from that. The company's insurance brands include auto insurance company Geico and reinsurance firm General RE. So this is really the two businesses, and they bought a business recently, Allegheny Insurance, a large insurance company here in the US, but really Geico and General RE have been really the money spinners for Berkshire with regarding that float that I talked about a few moments ago. Its non-insurance subsidiaries operate in diverse sectors. These are the businesses that Berkshire owns outright, as confectionery, retail, railroads, home furnishings, machinery, jewelry, apparel, electrical power, and natural gas distribution. So it's a very significant conglomerate. In fact, Berkshire Hathaway, as you'll see shortly, I think is the largest employer in the United States. Among its partially owned businesses, it does own some businesses partially that are not listed on the share market, such as Pilot Flying J. It owns 80% of that business. Some of the businesses that are listed on the share market, Kraft Heinz, American Express, Bank of America, Coca-Cola, and Apple, they're very significant stakes in those businesses that are listed there. And I do believe recently Berkshire has actually got closer to 90% of Pilot Flying J, which is basically if you travel, say, for example, as we will, but next Wednesday, drive between California and Utah, you will go through Nevada and Arizona for a short period. And Pilot Flying J are basically big truck stops. They're basically service stations, but really big ones and very, very high quality ones. Berkshire is the 7th largest component of the S&P 500 index and the top ranked company in the Forbes Global 2000, which takes into account both market value and fundamental data. The company is one of the largest American-owned private employers in the United States. Its Class A shares have the highest per share price of any public company in the world, reaching $500,000 per share in March 2022, because Buffett chooses not to split the stock. Now, of course, we wouldn't likely have anyone here at Trading Mastery own Class A shares. We all own Class B shares, and I want to share with you what the Class B share is. Through the 60s, 70s, and 80s, if you had have owned Berkshire Hathaway shares back in the 70s, for example, they were a couple of $100. In the 80s, they went to closer to $1,000, and in the 90s, the Berkshire Hathaway shares, there was no Class A and Class B. It was just Berkshire Hathaway, got up to $3,000 or $4,000. That original share is now $500,000 per share, one share. Now, what happened was, due to what Wall Street loves to do, and that is create products and derivatives for people to invest and trade, back in the 90s, Wall Street was basically coming up with all kinds of products, ETFs and all sorts of things, saying to people, look, you don't need to have $10,000 to own Berkshire Hathaway shares. You can buy them as a partial share here, and you can create, they were creating products that Warren Buffett and Charlie didn't like. So what they decided to do was issue some shares that would have a lower voting rights. So they came up with Berkshire Hathaway Class B shares. And that enabled the average mum and dad investor that couldn't afford to buy the Class A shares at that stage, which were many thousands of dollars. It would give them the opportunity to buy some Berkshire Hathaway shares at, say, $50 or $60 a share. And the share price would mimic the movement of the Class A shares. So basically, you could become a legitimate shareholder of Berkshire Hathaway, but you just wouldn't have the same voting rights as a Class A shareholder. So now, of course, most people, me included, really don't care too much about the voting rights because I have absolute faith in what Warren and Charlie are doing, and it doesn't really make any difference to me. But essentially, most retail mum and dad investors will own Berkshire Hathaway Class B shares if they want to own Berkshire Hathaway. Many of the big fund managers, institutions, BlackRock, Vanguard, Fidelity, etc. Many of the super investors that you'll meet shortly in this presentation, some of them own the Class A shares, but most of them own the Class B shares along with you and I. Berkshire Hathaway traces its roots to a textile manufacturing company established by Oliver Chase in 1839. So Berkshire Hathaway has been around for, coming up, in the next 15, 20 years, a couple hundred years, as the Valley Falls Company in Valley Falls, founded in Rhode Island. Chase had previously worked for Samuel Slater, the founder of the first successful textile mill in America. Chase founded his first textile mill in 1806. In 1929, the Valley Falls Company merged with the Berkshire Cotton Manufacturing Company, established in 1889 in Massachusetts. The combined company was known as Berkshire Fine Spinning Associates. In 1955, Berkshire Fine Spinning Associates merged with the Hathaway Manufacturing Company, which had been founded in 1888 in New Bedford, Massachusetts, with profits from whaling and the China Free Trade. So essentially, ultimately, these businesses merged together to create Berkshire Hathaway. Hathaway had been successful in its first decades, but it suffered during a general decline in the textile industry after World War I. And really, Berkshire Hathaway was known, and you would sort of appreciate this because if we look at old photos and old video footage back in the 1900s through to the 1920s and even the 1930s and into the 1940s, if you're going outside, most men would wear a suit. Most men would wear a jacket, and that jacket would have a lining, a linen lining or a cotton lining or something, and that was being manufactured by Berkshire Hathaway. So, of course, ever since then, clothing styles have changed. China is now manufacturing most of the textile for a lot of those suits, etc. today. And the Berkshire Hathaway business really struggled after World War I. At this time, Hathaway was run by Seabury Stanton, whose investment efforts were rewarded with renewed profitability after the Great Depression. So a period of time, Berkshire Hathaway did shine, but ultimately that shine started to decline. After the merger, Berkshire Hathaway had 15 plants, employing 12,000 workers with over 120 million in revenue, and was headquartered in New Bedford. However, 7 of those locations were closed by the end of the decade, accompanied by very large layoffs. Along comes Warren Buffett. In 1962, Warren Buffett had been studying, working with, and investing alongside a guy by the name of Benjamin Graham. And Benjamin Graham is, as Warren Buffett likes to say, was his mentor, is the guy that actually taught him how to invest. There's actually a famous book by Benjamin Graham that Warren Buffett often references, which I'll talk about a little bit later on. I wouldn't recommend a new investor read it, but it is a book that ultimately you should probably have a read of at some point. We'll touch on it later. But in 1962, Warren Buffett began buying stock in Berkshire Hathaway, even though the business was declining, after noticing a pattern in the price direction of its stock whenever the company closed a mill. So to sort of cut a long story short, Warren Buffett, when he worked with Benjamin Graham, the way that he was looking to buy businesses and make his fortune back in the 50s and 60s, Buffett is 92 now. He bought his first shares at the age of 11. A company called City Services were preferred. And basically, he's been investing since the age of 11. So he's been investing for 81 years now. He really, in the first few years of his investing life, he did all the sort of things that most people do. He did technical analysis and he did all kinds of investing, looking to buy cheap stocks and things. And ultimately, after he met Ben Graham showed him how to look for average businesses that were really, really cheap, that he likes to describe as cigar butts. You know, they're basically free. You walk along the street, you see a cigar butt or a cigarette on the ground. It's got a very small amount of, what he likes to describe as puff left in it, but it's free, it's cheap. And he was looking with respect to Berkshire Hathaway as a business in decline, but it was cheap and he might be able to get one puff out of that. Later on, I'll talk about Charlie Munger and how he changed Warren Buffett's investing strategy. But essentially, he bought Berkshire Hathaway, acknowledged that the textile business was waning and the company's financial situation was not going to improve. In 1964, after Buffett started buying the shares in 62, so 2 years later, the CEO of Berkshire started to send Buffett letters and made him an oral tender to buy back Buffett's stake for $11.50. And Buffett thought about it and he thought, yeah, okay, I'll sell my shares. I don't actually know what the profit was going to be on those shares, but he agreed to sell them back to Berkshire Hathaway. It's an interesting story because a few weeks later, Buffett received the tender offer in writing, but it was for less. It was for 11 3/8. And Buffett later admitted that this lower undercutting offer really pissed him off. And he actually has only spoken about it really once in a documentary that you can find on YouTube. I'll see if I can put it in the report on Monday. And it is also in the authorized biography of Alice Schroeder did of Warren Buffett that was released in 2008 called The Snowball. And I would highly encourage you to read that book as an investor. Warren Buffett says that this tender offer that Berkshire Hathaway was offering him at the time, and then really dudded him a few cents when it came in writing, was right at the time that his father died. His father was, his hero in his life. He was his biggest mentor. His father meant the world to him. And unfortunately, his father died around the time that this was going on. And Warren Buffett, instead of selling at the slightly lower price, Buffett decided to buy more of the stock to take control of the company. And he was so pissed off, he wanted to fire the CEO. So Buffett said, nope, screw it. I'm going to buy more shares, which he did. However, this made Buffett the majority owner of a failing textile business. So he bought enough shares, fired the guy who dudded him, and all of a sudden he realizes that, hey, I now own Berkshire Hathaway and this business is failing. What am I going to do? So Buffett initially maintained Berkshire's core business of textiles, but in 1967, he was expanding into the insurance industry and other investments. Berkshire first ventured into the insurance business with the purchase of a company called National Indemnity Company. So Warren was a very avid money manager in the 50s and early 60s, looking after some friends' money and his own money. He doesn't do that anymore, of course. And Berkshire was part of that. In the late 1970s, Berkshire acquired an equity stake in GEICO, which stands for Government Employees Insurance Company, which forms the core of its insurance operations today, and its major source of capital for Berkshire Hathaway's other investments that I talked about earlier. But it was 1985, actually the very first time I came and lived in the US, that the last textile operations of Berkshire Hathaway were basically shut down. And Warren says that one of the things that he regrets the most, and one of the most difficult things he's ever done in his life, was to close that very last Berkshire Hathaway textile mill down, because it was located in a town in New Hampshire that basically relied on the mill. Every business in town was going to go out of business because he was closing down the mill. And he said it really, it weighed on his mind heavily for a long time. In 2010, Buffett claimed that purchasing Berkshire Hathaway was the biggest investment mistake he had ever made, and claimed that it had denied him compounded investment returns of about $200 billion over the subsequent 45 years. And when you think about it, it was a pretty dumb thing to do, that the CEO came back and made the offer in writing slightly lower than the $11.50 they agreed on the phone. And Warren went out there and bought enough shares just to piss this guy off and sack him, and then ends up with a business that is basically failing, and he's got to try and figure out what he's going to do with it. That's the reason why he says it was the worst investment he ever made. But the reason why Berkshire Hathaway exists today in its name is because of the textile mill. There's no other reason for that. Buffett claimed that had he invested that money directly in insurance businesses instead of buying out Berkshire Hathaway due to what he perceived as a slight by an individual, those investments would have paid off several hundredfold. So that's a little bit of the story of Berkshire Hathaway. And just to recap once again, Berkshire Hathaway essentially is two businesses. One, the listed companies that are listed on the share market that it owns, Coca-Cola, American Express, Apple, etc., and also the private businesses. With respect to the number of shares that are issued that we can buy and sell, times the valuation of the shares comes to $680.077 billion. Due to the nature of Berkshire Hathaway, I don't give consideration to PE ratios or earnings per share. I'm going to share with you why in just a moment. Because Berkshire is unique in that it has a share portfolio of about 300 billion, and it has businesses that it owns. So it's legitimately a conglomerate. So it's very difficult to use general financial metrics as we ordinarily would do perhaps for a business that we would look at here for due diligence. Regarding the profitability, the net income of the business, the bottom line profit at the end of the year, I thought I'd share this with you because it's a really interesting numbers all the way back to 2010. Berkshire was making, excuse me, Berkshire was making just shy of $13 billion of profit back in 2010. And all the way through to 2021, it grew that annual profit to $89.795 billion. So at the end of 2021 financial year for Berkshire, it made just shy of 90 billion, up from roughly 13 billion. So a fantastic increase. You might look at 2022 and say, well, gee, a loss of $22 billion, what's going on? I'm going to share with you why that loss exists in just a moment to help you appreciate what happened there and why the business actually posted a loss in 2022. And it's all got to do with the share portfolio. Okay, so we'll get to that in a moment. Over the course of the last 50 years, Berkshire Hathaway has compounded investors' returns at close to 20% a year. Not as great in the last 5, 10, 15 years. You can see there, if you've owned it for the last 10 years, you would have made just shy of 200%, 20 years, 265%. Berkshire Hathaway, for me, as an investor, is what I would describe for me as my exchange traded fund. So we could make an investment and we could say, hey, I want to buy all of the businesses in the S&P 500, right? And we could go out there and we could go to Vanguard and we could type in the code VOO, which you could put into your Saxo platform, the code VOO, and it'll bring up the S&P 500 ETF, the exchange traded fund. And for a fee of 0.1%, so, you know, a tenth of 1%, we could own a little piece of every business in the S&P 500, okay? Now, on average, the S&P 500 for the last 25 years has delivered a return on investment of about 9.5%. Okay, some years better than that, some years a little less than that, but on average about 9.5%. Berkshire Hathaway has done a little better than that, not hugely better than that, but it has done better than that. And I believe going forward that it will do better than that in the next 25 years due to the makeup of the business, the economic moat that it has with regarding the businesses that it owns and its most valuable assets that I'll talk about shortly. So for me, I believe by having a very large position in Berkshire Hathaway and an even larger position going forward, I'm going to be exposing my money to some of the best businesses in this country that are run by executives that are some of the smartest, brightest, most respected people on the planet. So I could say, okay, well, I'm going to buy the S&P, or I can say I can buy Berkshire Hathaway, which is basically a conglomerate. And when you own Berkshire Hathaway, I'm not the first person to say this, you own a little piece of America, is basically what you own. You own one of the biggest employers. They own some of the best businesses in the country. They're the largest shareholder of some of the biggest businesses in the world today. So I prefer, rather than to have an S&P 500 ETF, I prefer to own Berkshire Hathaway. And I'll share with you as we go through why I'm going to be building a larger position in Berkshire Hathaway, and just explain for you what I'm attempting to do if you didn't read the report this week with regarding my investing, and you might like to give consideration to something similar to this going forward. You don't have to copy it, but I believe that it's going to serve me well over time. So here is the reason why Berkshire Hathaway posted a loss in 2022. You can see there, second from the bottom, it says investment and derivative contract gains losses minus 53,612. Remember I said to you that Berkshire has a share portfolio that was actually about $320 billion, might have even been a little bit more than that at the end of 2021. Due to the nature and the size of Berkshire's portfolio, we know that the S&P 500 last year was down about 19.4%. And we know that Berkshire Hathaway is the largest shareholder of American Express, Coca-Cola, Apple, Kraft Heinz, Moody's, and many, many of the largest contributors, largest contributors to the S&P 500. So if the S&P 500 falls in the short term, in 1 year, by, let's say, 20%, then Berkshire Hathaway's portfolio valuation of the $320 billion of shares that it owns is going to see a significant decline as well. So that's the reason why we saw that once-off decline in Berkshire Hathaway's P&L at the end of 2022. As you'll see in a moment, or as you can see on the screen here right now, if we look at all of the other components of Berkshire Hathaway, insurance, railroad, utilities and energy, manufacturing, etc., those businesses are continuing to get better. And we all know as well that the S&P 500 will ultimately continue to get better. I mean, we do see declines from time to time. As we know, generally speaking, 7 days out of every 10 are higher over time with respect to share prices. So the decline in 2022 of the portfolio at Berkshire is short-term. It's not a long-term decline. There is nothing wrong with the business. And that's exactly the reason why the share price on the day of the profit and loss statement being released, the market took no notice of it, because the market already knew that that was going to be the case. And the underlying businesses that make up basically 2/3 of Berkshire Hathaway, the businesses that it owns, are actually continuing to perform better over time. Now, looking at Berkshire, because it is a conglomerate, it doesn't report or can't report return on invested capital. It has a 5-year average return on equity of about 11%. And remember, as Warren Buffett often says, we expect that Berkshire Hathaway will perform roughly in line with the S&P, maybe a little better. He's very humble when he says these things. It generally performs quite a bit better than the S&P over a long period of time. But I did share with you just a couple of days ago what the difference between, and I've got some slides coming up shortly that will help you appreciate this, what the difference between about a 9.5% return versus a 12.5% return does over a long period of time. Over 20 years, the difference is double the return on investment to a shareholder. So you might be expecting that this business, if it's a large part of my portfolio, I'm looking for it to make me 15 to 20% a year. Well, that's just simply not the case. I'm looking for it to perform a little better than the S&P, and there's a reason why for that. I'll explain shortly. So assets and liabilities, when we're looking at the business, the company has assets of about $950 billion. So, that's across its cash and all of the various plant, equipment, companies, etc., that Berkshire owns. And it currently has total liabilities of $467 billion. So it has a price to book of what we call 1.41. So in my opinion, the Berkshire Hathaway business right now, as we sit here, is very, very fairly priced. I believe the Berkshire Hathaway business, to be frank with you, is cheap right now. And I'll explain a little bit more about this as we go forward. Looking at the consolidated statement of earnings, you can see down the bottom there where it said net earnings loss 22 billion. The previous year was 90 billion of profit. We know why that 22 billion is there. It's simply because of the decline in the portfolio of shares in 2022, as it will likely turn out to be a once-off. I mean, put it this way, if the market went back to where it was at the end of 2021 within the next 12 months, well, Berkshire would be back making likely over $100 billion of profit. So as Warren likes to say, and it is very true, don't look at the P&L of Berkshire Hathaway on a quarterly basis or an annual basis and just take from that as you would normally do from a company. Understand the business, because it may be swung either way by an excessive valuation of the company and the share valuation. For example, in 2021, due to the nature of the share market overshooting to the upside, Berkshire had a profit of 90.8 billion, and the year prior to that, 43.2. So there's a big swing there often based on the share valuation, but the businesses continue to get better. The two going forward, I'm just going to explain for you here now why part of the rationale behind me wanting to own a large position of Berkshire Hathaway. First and foremost, I genuinely believe it's the best run businesses in the world today. I don't think it's a business that has been run as well over a long period of time. In fact, I know there's not, because this company has made tens of thousands of millionaires. It's made a few hundred billionaires from people owning shares in this business. But essentially, the way this business is run from an ethical perspective, there's just nothing comes close to it. And the executive team that has been in charge, which has obviously been Warren and Charlie, for the last 15 to 20 years, this is the most common question I get asked from people. What's going to happen when Charlie and Warren are no longer around? Well, Charlie and Warren are not silly. They realize they're not going to be around forever. They've built this business. They want to leave a legacy, but they want to make sure the shareholders of Berkshire Hathaway are well looked after. They have appointed a number of executives to the business to look after the business long after they're gone. The gentleman that will take over from Warren is a guy by the name of Greg Abel. And one of the other gentlemen that will be a senior executive is the man that's running the insurance operations, a guy by the name of Ajit Jain. He's been there for 25 years. Greg Abel's been there for 15 years. Todd Coombs and Ted Weschler will be looking after the share portfolio. And essentially, Berkshire, in my opinion, for the last 10 to 15 years, many of the quality decisions that it has made has actually come from that executive team with Warren and Charlie. So they have essentially been learning from Warren and Charlie for the best part of, in Ajit's example, 20 to 25 years. In Greg's example, more than 15 years, and Todd and Ted roughly the same. So do I sit here today and worry about, whether Berkshire is going to be, looked after Charlie and Warren are no longer at? No, I don't. I think the business in many regards could be better. It may even run better in time. So guys, just give me 1 second. I'm going to have to grab some power because my power cable is about to run out. Give me 1 sec. I'm going to come back and give you some power. Sorry, guys. Right. We should be good to go now. So, the two biggest assets that I see that Berkshire Hathaway owns is number one, the railroad, and number two, the energy business that it has that continues to grow and continues to get bigger. And I believe these two assets over the course of the next 50, 60, 70 years are going to be so valuable that the share price of Berkshire Hathaway today, I believe, is, from a fair value perspective, the share price of the Class B shares is a bit over $300. I think that's closer to $350 fair value today rather than where it is right now. And I'll share some interesting stats with you in just a moment. But the utilities business here and the energy business is a massive cash cow for the company, along with Burlington Northern Santa Fe. Buffett's decision to buy Burlington Northern Santa Fe back in about 2009, 2010 was one of the best decisions he ever made. And Greg Abel, the gentleman that will take over from Charlie and Warren, has been running the utilities and the energy business, which I think are the two businesses that will become more valuable over time for Berkshire. I think the insurance business of Geico and General RE, those businesses will fade off into the distance. These are the businesses that are most valuable for Berkshire Hathaway. And, the other benefit that you get when you own a business like Berkshire for a long period of time is the fact that it continues to buy its own shares back. Okay, I'm going to share some more detail in this in a moment and compare Berkshire and some other businesses as to the benefits of owning a company for a long period of time. So Berkshire Hathaway, over the course of the last few years, and will continue into the future, has bought a huge amount of its own stock back and retired that stock. It's not giving stock out in cash bonuses to executives or staff or anything like that. It is buying back its shares, retiring those shares, which makes every single shareholder wealthier, and it doesn't cost you a single dollar when the company does this. Now, you can see here, and this is actually easier to understand. In 2017, there was 2.46 billion shares outstanding. And you can see that the share count going down and down and down and down. And down the bottom, you can see that in 2020, shares outstanding declined by 2.42%. 2021, they declined by 4.29%. And in 2022, declined by 2.74%. What that means is, just think of it like this. Think of it that you're a shareholder in a business where there's 100 shareholders, okay? And you own 10 shares. And the company makes $1 million. And it gives out 50% of that money in profit to the 100 shareholders. And the balance of the money, some of the balance of the money, it decides to buy some of the other shareholders out. The other shareholders want out. They're happy to sell their shares. So the company buys those shares out and retires them. So it hasn't cost you $1. And your shareholding has gone from 10% to potentially 12, 13, 14, 15%. It hasn't cost you anything in tax. And the company's made you a larger shareholder because it's been able to buy those other shares and retire them. That's basically what Berkshire Hathaway has been doing. A lot of other businesses do it. Apple does it. Home Depot does it. Costco does it. Most companies will ultimately buy shares back and reward shareholders. But in the case of other businesses, it goes in reverse. And this is one of the reasons why I don't own a business like Tesla because I don't think the business is run from an ethical and moral perspective the right way for shareholders. Have a look here at the share count at Tesla. In 2015, the share count was 1.923, and 2022, the share count is 3.475. And you go down the bottom, in 2020, the share count increased 22.1%. The share count increased in 2021, 4.22%. And 2020, this is not the share price, this is the number of shares being issued. Who do you think got most of those shares? Elon Musk and executives. They're issuing shares and it's diluting the shareholders that own the business. Now, most people don't even see this happening, right? Most people don't see it happening. Now, if I go forward to a business like Apple, look at Apple. Apple's share count is just like Berkshire Hathaway. It's in reverse. It's going down. It's gone from 22.001 to 16.326 from 2016 to 2022. In 2020, the share count went down 5.74%. In 2021, it went down 3.78. In 2022, it went down 3.2%. So every time the share count goes down, if you own Apple, you get wealthier because you own a bigger slice of the business. Ultimately, you will get larger dividends and all of those sort of things because of the business and the share count going down. But if the opposite is happening like at Tesla, and there's plenty of other business like Tesla, I mean, Tesla is just the easiest example to give. And this is one of the reasons why Elon Musk has become the richest guy in the world, because he's got most of the shares for free because he got them in bonuses, but it goes against the shareholder interest. Very, very important to understand that, guys. So let's move on now with respect to Berkshire Hathaway over the course of, the last number of years, from December 31, 2017 to now, the end of 2022, when Berkshire Hathaway reported this, $100 investment in the S&P 500 and Berkshire Hathaway is basically exactly the same. Okay, so I'm talking about the last 5 years. Basically, the S&P and Berkshire has performed about the same. If you had have owned a property and casualty insurance index ETF, you would have done a little bit better than that. But if you $100 would have turned into 157 in the S&P and roughly the same in Berkshire Hathaway. And you can see here that there is a significant amount of shares being repurchased by the company over a long period of time that is benefiting all of the shareholders. And we've already talked about that. Looking at the Berkshire Hathaway super investor stats, there are a number of super investors. Some of my favorites: Li Lu, Guy Spier, Francois Rojon, Thomas Gaynor, Thomas Russo, Wallace Weitz. These people are incredibly successful value investors, people that consistently over time beat the S&P 500. And many of them have Berkshire Hathaway as their number one position in their portfolio. So there's 21 super investors own Berkshire Hathaway. And this is, in actual fact, the Class B shares here. The Class A shares, there are 13 super investors own Class A shares. So again, Francis Chu, Norbert Liu, Christopher Bloomstrand, Thomas Russo, Guy Spier, Tweedy Brown, Thomas Gaynor, Christopher Davis. These are significant value investors that hold very large positions. And you can see on the right-hand side that the value of those positions, between 37 million all the way up to 1.2 billion for Thomas Russo in his portfolio. If we look and see, well, okay, when were they last buying shares in Berkshire Hathaway? Well, this is the last quarter of last year. David Rolfe, Christopher Bloomspan, Yakman Asset Management, David Katz, First Eagle, were all buying shares in Berkshire in the last quarter of last year, as was they in Q3 2022 and Q2 and also Q1. Now, on top of this, don't forget, we had Berkshire Hathaway itself buying its own shares. Now, interesting, I didn't mention before, and here's some more stats here of some Class A shares being bought by Chris Bloomstrand and Francois Rojon. But I just wanted to share with you something that's very important. On the screen right now is the Dow Jones Index, which is basically the top 30 stocks in the US, and Berkshire Hathaway, which basically you can see there that the chart mimics the other one. And you can see that the share price, when I did this slide earlier today, it's a little bit higher than this right now, but it basically around $310. Warren Buffett and Charlie Munger will never, ever buy shares back using shareholder money or cash within Berkshire Hathaway unless they genuinely believe that Berkshire Hathaway is trading well below what they believe it's truly worth. So one of the biggest mistakes that Buffett says that a lot of publicly listed businesses make is that they use shareholders' cash and they buy back shares when the share price is too high, when it's not trading below what he likes to call intrinsic value, basically below what they believe the business is worth. Now, this is really important. In 2021 and 2022, and let's talk about 2022 because that was most recent, Berkshire Hathaway was buying its own shares back with billions of dollars, somewhere between $8 and $10 billion they used to buy shares back in the last 2 quarters of 2022. Now, if you go back there and you look on that chart there, or you go back on Yahoo Finance and you pull up Berkshire Hathaway's share price between around, the end of July all the way through to the end of the year, the share price basically just went up and down and sideways. It really didn't go anywhere. So Berkshire Hathaway is buying its own shares back between about $270 and $320 all the way through 2022. So what does that tell you? It tells you that Charlie and Warren think the company is trading cheap. They think the business is trading below its fair value. Even now, I can tell you Berkshire Hathaway is buying its own shares back. And Buffett, if you study him for long enough and understand the way that he invests, he will not buy shares back of Berkshire Hathaway unless he believes the business is trading substantially lower than what it's worth. And he's buying shares back right now. He was buying shares back in October, November, December. He was buying Berkshire Hathaway shares back in August and September last year. So one of the reasons why I am building a large position in Berkshire Hathaway right now, and will continue to do this over the next 3 to 6 months, is because I'm cloning Buffett. I'm cloning Berkshire Hathaway. I'm cloning the greatest investor in the world. If it's good enough for Warren, it's good enough for AB. Now, Warren doesn't make perfect decisions all of the time, but I can tell you he makes a lot more good decisions than bad ones. And he's become the greatest investor of all time. He's not the richest man in the world purely because he's given half his money away already. Over $100 billion he's given away. But right now he's buying shares back. Now, I have some cash. I have some family money. I look after our family's money. So I'm buying more Berkshire Hathaway, and it will become a very large position within my portfolio. Over the course of the next 6 months, it will become the largest position. This is just the share price there from around sort of September, where my cursor is, September. Basically, the share price has done nothing for 6 months. And Buffett's been buying shares back of Berkshire Hathaway all through this period here. And you say, well, why has he been buying shares back? Because he thinks it's cheap. He hasn't been wrong on this once, by the way, over the course of his life. And, yes, these guys are not going to be around forever, but they have been working with, training up, making sure the culture is right for when they're no longer around. So do I trust that they're likely making the right decision again? Yes. So the S&P 500 has on average delivered 9.5% over the past 20 years. So assuming the return is similar over the next 20 years, $1, I'm just going to use a basic number, $1 compounding at 9.5% would end up being $6.64 after 20 years. So if you want to add on a few zeros to that, you can do that, but let's just use $1, right? Now, if I can achieve 12.5% a year instead of 9.5%, that same $1 over the next 20 years would end up turning into $12.03, close to double the return of getting 9.5. Now, do I think there is a good probability that Berkshire Hathaway can deliver that? Yes. And I'm going to share with you why I want to have my portfolio skewed to the types of businesses that I own in just a moment, and why this businesses will make up a large part of it. If I was to get 15% on average each year for the next 20 years, $1 would grow into $19.72, which is more than 3 times the return on investment the S&P would earn me at 9.5%. Just by getting 5.5% more on an annualized basis, I would triple my returns over 20 years. So that being said, these businesses here that is going to come up on the screen, all right, let me just start from the top. The average return on invested capital for my top 7 holdings, right, which you're about to see in green, when they come up on the screen, they are my top 7 holdings. It's 83% of my portfolio. The average return on invested capital for these businesses is 19%. Now, the other benefits of owning these companies is that they will lower their share count and increase the dividends for ones that pay dividends. So let me share with you first the companies, and next to that is the return on invested capital that they're currently paying. 31.47, 10.98, 12.31, 18.61, 18.07, 18.76, 25.02. Now, if you've been with me for a while, you'll understand that if you own a business for 10, 15, 20 years, and it delivers an average return on invested capital of 19, the probability is, history will show that I will earn around 19% per annum over that 20 years on that money. Now, that's owning Berkshire Hathaway that has a return on equity of around 11, right? We need to use return on equity for Berkshire because it's a conglomerate. Now, the other businesses I own also have return on invested capital. Bank of America about 10, Home Depot 35, Disney and Occidental will improve closer to 12 or 13 within the next 12 months. And Macquarie is 16.13. So what is the probability, in my opinion? Now, I might be wrong here, but this is my risk. What is the probability these businesses deliver, let's say 15 to 17% return on invested capital on average for the next 10 years? Well, I think that the probability of that is pretty good. The quality of those businesses on the screen are extremely high. Now, the other thing that is important to remember, what's the probability I'm going to experience a major catastrophe owning the companies listed in the previous slide? The probability is less than 5%. Probably, I would say less than 2%. These are some of the most high quality businesses in the world today. I sleep well at night. I have no major risk on the table. I know they're going to be worth more money in the future, provided they continue to do the things they're doing right now, which I fully expect that they will. The answer is low in my view, and the potential is I'm going to do better than the S&P 500, provided I continue to own a collection of companies with above average return on capital and return on equity. All I have to do is own a group of businesses that have return on invested capital of well above 10%, which on average, I've got 19% right now, continue to buy more shares in them and sit on my lazy ass. That's it. That's it. And in the next 10, 15, 20 years, if I can do that, if I can continue to buy more shares and sit on my ass for a lengthy period, the likelihood is I'm going to do extremely well. It's not rocket science. I don't have to go out there and continue to find high risk investments that might go up 100% in the next 2 years. That's not going to help me achieve my end game. Now, if you want to speculate and do that, more power to you, but it's not what I'm interested in doing. So, Berkshire Hathaway, is it growing its profits? Yes. Is it growing its dividends and share buybacks? Well, it doesn't pay a dividend, but it has massive share buybacks. And does it have high returns on capital? Well, it has returns on equity slightly above the industry average. And I know this business on a yearly basis is probably just going to outperform the S&P by a little bit. So what I'm saying to you is I'm going to have my largest holding in my portfolio basically do a little bit better than average. The vast majority of my portfolio, the other businesses, Apple and Microsoft and Alphabet and Costco and Amazon, those businesses, I fully expect to do much better than the industry average. And there'll be one or two businesses amongst them, just one or two, that will absolutely brain it. That will do, they'll compound money at 20, 25% a year for the next 10 years. But I don't know which ones they are. It might be Micron. It might be Alphabet. It might be Amazon. It might be Microsoft. But the only way I'm going to know is to own them and continue to own them. And my worst case scenario is I'm probably going to earn about the S&P 500 average, which is going to get me a better result than leaving my money with a money manager. My best case scenario, I'm going to make between 15 and 20% a year. And, I'm going to have an incredible return on investment. If you try to do it any other way, in my opinion, the faster you want it, the riskier it is, and the harder it is to get. So that's my take on Berkshire Hathaway, guys. I'd welcome you any questions you might have for me now. Be more than happy to answer them if you would like to ask me any questions about it right now. Hi, Andrew. My 19-year-old son is keen to invest. He has a Saxo account and is able to invest $2,000 per month. Would you have any guidance for him? Well, if he's a client, Mark, you can give him access to the program. That would be the guidance. I mean, unless people go through the program, they don't understand what we do. So he'd have to go through the program to understand what we do. And if he goes through the program and you give him access to that via your username and password, then they've got to have skin in the game. They've got, and if he's excited and he's keen to do it, then I would say put him through the program. He's got to start reading the reports. He's got to start learning how the structure a portfolio, and it's all laid out there for him. So I wouldn't give him any different advice that I would give in the Knowledge Center and what we do on a daily basis or here in this classroom today. Just wondering, as I've sold our Hawthorne house and want to buy shares with the conversion rate being poor at the moment, do you feel this will improve? Got nothing to do with, Heather, with the conversion rate. This is another missed moment. You've got to go into the Knowledge Center, Heather, and find the video on understanding currency valuations and buying international shares. It's got absolutely nothing to do with the currency valuation, because the Aussie dollar is going to range between probably 60 cents and 80 or 90 cents over the next 20 years. Sometimes it's going to be 80 cents. Sometimes it's going to be 60 cents. Sometimes it's going to be 70 cents. It's going to average out at about 71, 72. Share prices just keep going higher and higher and higher and higher and higher. Currency valuations don't. So if you buy the right business, you buy it at the right price, a fair and reasonable price, and you own it for long enough, it's going to have nothing to do with the currency valuation. Okay? But there is a very specific video, Heather, in the Knowledge Center about that I would really encourage you to go and find and watch this weekend. It will really help. And if you've got any questions after that, certainly email us and help you. If you could ask Warren Buffett one question, what would that question be? Same for Charlie. What question would you ask him? Gee, it's a good question. Let me continue with the questions, Dave, and I'll come back to it. No, it's 35, Karina. It's 35. The last trailing 12 months return on invested capital for Home Depot is 38. I've added a large parcel of shares in Berkshire to my portfolio last week. On another note, I've been out of the loop for a while with live training and missed the updates as to why you exited your positions in Walmart. Okay, so basically, long story short, Marinko, I believe the money will be better served in the companies that we currently have in our portfolio. That's the bottom line. I mean, the only reason why anyone would ever sell any shares and move that money into another business is because you believe that money will serve you better invested in another business. And that's the reason why I've done that. Yeah. I'd say many members fail to watch all the videos on the Learning Center. It's all there, great quality videos. Thank you, Shane. I appreciate that. How do you calculate 15% over 20 years? Missed the figure. What at 15% RET or return over 20 years? You can go to a website called the Calculator site, Rosanna. There's a website called the Calculator site, and there is a compound interest calculator there, and you can work it out there. So go to the Calculator site, click on compound interest calculator, and you can work it out. It's great. It's a great site. I would really encourage it. Great stuff, AB. It's very useful and reassures. My investments are right place. Look forward to the next trade. No worries, Sam. Thank you very much. If a stock has barely risen less than 10% over 3 years, is that a signal to sell that stock and invest in a stronger anchor company with better growth and high return on invested like Berkshire Hathaway, Costco, Well, Brendan, the percentage gain or loss on a company is not what you should be looking at. The percentage gain or loss on a business in the share price tells you nothing about what the business is doing. It just tells you what the share price is. What I would be looking at is if I owned a business, for example, Flight Centre, right? I made a little bit of profit on that investment in the last few years, but I didn't make the decision to sell the shares because I made or lost 10 or 15%. I mean, we made closer to 20% on the investment, but if my investment was down on Flight Centre 10%, I'm not selling the shares because the shares is down 10%. I mean, you should never sell shares in a business just because the share price has gone down. You sell shares in a business if you genuinely believe there's something wrong with the business. So, if you've owned a business for 3 years and the share price is, risen only 10%, well, I assume that you've been following that business and you've been following it from the quarterly reports and the 6 monthly reports. And there are plenty of times where I've owned companies for 3 or 4 years and the share price has done nothing. And then in the following 3 or 4 years, the share price has risen 50 or 60%. And I think the easiest way to answer that question is the biggest mistake people make is selling a great quality business. There might be very valid reasons to sell a poor quality business, but you should know that if you're reading the reports and everything. What key risks, if anything, would you see for Berkshire going forward, or are they relatively risk shielded given their diversification? Well, I mean, every business has a level of risk. I think Berkshire Hathaway is very insulated in many respects, and you only need, the proof in the pudding of that is just to look at the share performance last year, and what the market did versus Berkshire Hathaway. Berkshire Hathaway's share price was up 9% last year, and the S&P was down 19.5%. Why was Berkshire Hathaway up 9% and the S&P down 19.5%? Because a lot of money that was sold out of a lot of other businesses, companies looked to Berkshire Hathaway as a safe haven investment. Berkshire Hathaway is going to be around no matter what. Berkshire Hathaway, if we had another COVID tomorrow and the economy shut down, it's got $130 billion in cash. It's going to be around in another 12 months. So it comes with risk. I mean, those risks are not evident to me that stand out and shine to me because the business is so well diversified and it's so well cashed up and it's so well run But certainly every business has a risk. The risk might be that Greg Abel decides to leave. Ajit Jain decides to retire. There's risks and there's trouble always around the corner. But I think they're well placed to get through those challenges, and they've done it for over 50 years. Is there a video on the training center that covers the right time to sell a commodity-based share? No, there's not, Vance, because we don't invest in commodities. We don't invest in commodity-based businesses because they're cyclical by nature. But if you were looking to, I'm not giving you specific advice here, but if you were looking to sell a commodity, then you'd want to sell it at a commodity price high rather than a commodity price low. But we don't have videos on commodities in our learning center because we don't believe investing in commodity-based businesses because they're very cyclical by nature, and the share prices rise and fall based on that cyclical nature. Great session, AB. What's the point in time you use for calculating if the share price is reduced enough to become a golden triangle company? It's on the list if the share price is down 20% or more on the list, and I'll be updating that list again in the next few days. Yeah. All right, guys, we'll leave it there for today. I hope you had a great day. Again, my sincere apologies about the password mix-up and having to race and grab my power here. But we'll be back on Wednesday for our Chew the Fat. So I hope you can enjoy that session. Have a wonderful weekend. Hope you learned something today. Bye for now.